Very big week looming. Let's show you what's going on. We have the busiest week of earnings season coming up. You know about the mega caps. 5 of the 7 are reporting. Jensen Huang gives a keynote on Tuesday. The Fed decision is on Wednesday. The meeting between the presidents, Xi and President Trump, of course, on Thursday. So we got a lot to look forward to. Weiss, I think it's interesting that this market looks at CPI cooler. It's convinced the Fed's going to be engaged, and highly so. It has a ticket to cut, and a ticket to cut multiple times. Your move the other day of either trimming or selling out of Alphabet, as you expressed it, was in part, as you said, to take down your exposure a little bit. This market doesn't seem like it wants to go down.
Yeah, and I should have been clear. Take down my exposure in the assets that basically all have the same end game, which is cloud, which is AI. So I've got large positions, and I haven't sold all of Alphabet yet. I'm probably going to sell it into the earnings. I'm waiting for more of a run, so I'm concerned about search. But I've got large positions in Microsoft, in Meta, in Taiwan Semi. Not as large a position anymore in Netflix, which is separate, and they're all playing the same things. They all trade alike. I don't need that exposure.
I know, but you were a little bit cautious the other day in the overall market.
And I still am.
Yeah. Why so?
Well, I just think that at this point, the Fed cut is in the market. A couple of Fed cuts are in the market.
Is it? How is that possible, given the move today?
Well, we'll see when they actually do it. I think that today was the answer is, Scott, these moves perplex me because you discount the news once, which got us to the level before today. Then you discount the news again when you get news like today, which it was better than expectations, frankly. But 3% inflation is still way above the Fed target. But this continues to be a half full market. But the risk is in some of those names, not long-term risk, but valuation risk, price risk in some of those names I have. So I have been cutting back. So I have more cash than I've had before, but it's about 3-4% cash position. Right. So it's not significant.
All right, who wants the other side of that? Go ahead.
Yeah, I think valuations are a tough timing tool. I think Steve would agree with that.
Yep.
I think we have rate cuts. We have meetings with Xi next week. We have earnings that have come in positive. We have earnings revisions that are headed higher. We have positioning that has moved back decidedly to neutral or slightly under. And so from our lens, the chase is on until the end of the year. We have a lot of liquidity in the markets. You're looking at cash building. You're looking at positioning in gold building, which could arguably be a catalyst given the performance of gold of late to get investors back engaged in traditional equities. And so while I think Steve's right to be mindful of valuation, I think there's other things that are happening right now that are pressing the market higher.
I mean, the market doesn't seem to care at all
about anything.
President Trump's tariff whims or anything because the economy's good. Earnings are good, and the Fed's going to cut.
Earnings can be great.
The Fed's going to cut a bunch.
Right. So just so I'm clear, I'm not bearish, right? I'm repositioning. So we'll talk about a move I made before.
Yeah, we have a lot of moves to get to today. We will.
And that's why I've raised some cash because I want to diversify the portfolio. Number one, as I did with Cat earlier this year, which has worked out to about 40%. And I'm looking to do that further when I can go bargain hunting. So that's why I won't have the cash. I don't want to have to sell at a particular point in time, and I am concerned about Alphabet Search.
I mean, it's funny. Those who were looking for a pullback, you had private credit bubble up, and people got a little bearish around that, and other, issues that were out there, what's going on between the U.S. and China. People got a little bearish about that. And then here we are at new record highs. The market seems to brush it off. Those who are looking to find bargains or have an opportunity to buy lower haven't really had the opportunity unless they were as nimble could ever be.
You can't fight this. I mean, I hate the trite sayings that I've been saying for the past couple of weeks, like don't fight the Fed, don't fight the trend. You just got to believe in it. Look at the price action. And by the way, Steve, I understand and agree with your perplexity, to use that word that you used. I'm just simply observing that anytime the market goes down, it doesn't even get 2% down off the high before it gets bought. And I'm not justifying it. I'm saying that's what's happening. If I try to explain it, what I say is there's a lot of cash on the sidelines.
You don't have to feel bad to justify. I mean, you don't have to put a disclaimer out.
No, the reason I'm doing that is because I understand where Steve's coming from. You look at this and you do say, isn't this already priced into the market? But that sort of analysis, the analysis that we all like to do, just doesn't matter. This is a trend is your friend sort of market. And you see it in how much cash comes into the market on the slightest dip, whether it's retail and money market funds, whether it's professional money managers trying to catch up to the benchmark. It just is what it is. Another trite saying. Now, there is justification, and Rob said it, with rate cuts coming, deregulation, and you know what? If you do get a China-U.S. trade deal, we go higher on it. That's just where we are. We'll worry about this in January, but right now the trend is your friend.
Yeah, allow me to remove the perplexity, because you're asking, why is the stock market up today if we've already baked this in? And I think we baked in a rate cut for sure next week. But today gives a green light for another cut in December, and well, to your point, Scott, more cuts next year. I'll make the case that this could be the last three handle we see on CPI. I think inflation could be coming down even lower, and this is all the reason why we're seeing the move today. Plus, next week we get all these earnings reports, especially with the Mag 7. I just think that there's so much enthusiasm behind this market today, specifically for good reason.
There are those who are thinking, that 3% is the new 2%.
Well, I'm going to tell you something.
It's not going to prohibit the Fed from going.
Shelter is a very important component. That's what you saw today. You said goods inflation, but shelter deflation. Shelter makes up a disproportionate portion of the CPI, and it's going to be in a downward trend for a while. And then you have interest rates coming lower, which is going to spur building activity, which should also ultimately be, from a price standpoint, deflationary, even though it'll stimulate economic activity. And so I think the inflation story, I don't want to say it's dead, but it's at least put behind us for a while, because the tariffs aren't hitting the key goods like gasoline prices, because they're exempt from things like that. And so what ends up happening is goods inflation is really just hitting the high end of the market, which can completely tolerate it because they own the Nvidias, they own everything that matters. So they're ignoring it. And in the consumer economy, which really reacts to rents, right, and gas prices, you're seeing them not react to it either. And so it gets back to this situation where you can continue to have this momentum.